With July 4th behind us, along with the first half of the year, the U.S. economy seems to be getting stronger after a rather rough start. Employment's picking up, investment markets are hovering near all-time highs, but people like you and me aren't exactly experiencing those same highs yet. Is there reason for hope? Joe Krier, president of Krier Wealth Management, here to talk about the year so far and what's to expect for the second half of 2014. What global factors influenced the first half of the year?
Yeah, I mean, well, the biggest thing that happened to us was a brutal winter, of course. You know, that got things off sort of in a shrinking mode as we started the year. But then we had Ukraine and Russia going on, which is still going on as we speak. And of course, the Iraq situation, all these things tend to destabilize the global economy. And although the economy's had some shaky moments, it's kind of plowed through the winter, so to speak, and started to pick up as we go into the summer here.
You talk about the Iraqi insurgents. It's interesting to note that I heard a report this morning that oil prices are actually coming down because they didn't have the impact on oil supplies that the Iraqi insurgents thought they would have.
Yeah, there was a little bit of a spike there, and it is one of the factors that we're watching is inflation over the next 6 to 12 months, of course, and we've seen it in food a little bit and starting at the pump, but not as much as people expect. So it's one of the things helping this economy move along nicely.
You talked about Europe, China, and Japan. How did they influence the economy here?
Yeah, they've all had their ups and downs this year, too. And, of course, Europe has come out of a real rough 2013. They're not out of the woods yet, and that could be a front-page story any Monday along the way. And China's had some wobbles here. It looks like a potential real estate bubble there. And Japan is sort of artificially stimulating their economy at a rate 3 times that of what the U.S. has done over the last few years. So even though we have a nice little balance going here, there's a lot of things that could be headlines any given day.
Got some fairly good unemployment numbers that came out last week, but there are also some mixed signals that may mitigate that.
Yeah, definitely. And, you know, Friday we had, I think it was the 6th month in a row of new jobs added above the 200,000 mark, and the unemployment rate dropped to 6.1%. Under the surface, though, those numbers don't reflect all the people that gave up on seeking work. In fact, we've got about 38% of Americans who are either retired or just not looking at all, and that number is sort of historically low. So it's a little bit bad for us to sit here and talk about a great economy, because I know there's people that are out there that are either in part-time jobs they don't want or still looking, and it doesn't feel very good to them. We need an economy that heats up enough to get everybody where they want to be.
And talking about mixed signals, I mean, the financial markets have been performing extremely well, but that doesn't really tell the whole story.
Yeah, that's true. And, you know, the Dow hit an all-time high just on Friday here. We've got the S&P 500 and other indices hovering around all-time highs. But the big worry here is this all because of artificial stimulus from the feds, keeping interest rates extremely low and pumping money into the system? And then, of course, is there inflation around the corner? We know that if there's more cash being pumped into the system, eventually the price of everything has to start going up.
So we've got a yellow light. Proceed with caution.
That's a great way to put it, Bruce. I mean, we're in a situation where everything is good. The U.S. markets seem to be the best place on earth to invest, and individuals just need to kind of take it easy here, not get too wrapped up, not get too excited, and be ready to maybe back off a little bit if things start to crumble.
Joe Krier, Krier Wealth Management.
Good to see you.
Thanks. We'll have you back soon.